The range of the doji contains the real bodies. More importantly, that's the range or where the market closes. The market is closing. Think about this. The market is closing still unchanged. It's a consolidation pattern. This almost represents what? A bull flag. And look what happens. The market takes off. In fact, here's another failed doji top there, and the market keeps going. What is the neat thing about this? The market closes above the doji high, as you see here. All right? And then here's another one where the market closes above the doji high. And in here, the market closes below the doji low. So paying attention to where the market closes in relationship to the doji's high and the doji's low, that's what's going to help you to determine when to stay with a trade, when to get out of a trade, and also when to add on to positions. It's very important. So having a high close or a failed doji pattern, a high close over a doji after an uptrend, most times does not signal that the market is close to an end. In fact, a failed doji top can also be one of the most powerful, lucrative trading signals that you will notice when using foreign currency in the Forex markets. Now, more rules to follow here. The second candle after the doji that makes a higher closing high, that triggers the buy. So it's the high close above the doji that really defines the breakout. Remember that. And you can go back to this course and review this. Let's go back and look at this a little bit more in depth, shall we? Now notice here where I've already drawn, here's the high of the doji, here we have a low close doji. The market, our first high close doji, which we haven't gone into yet in the course, but we're going to, because that is really my signature setup, and that's the money maker, one of the top money makers. These are the patterns that I'm looking at. I'm not looking at your traditional inverted head and shoulders or head and shoulders top, or looking at pennants and flags and whatnot. I'm looking at the relationship of the formations of the market where it closes in relationship to certain candle patterns. Notice here that we see the market has a high close doji right here. The market takes off, we see a doji, and again we see a low close doji. That should signal that the market's going to continue lower, and it doesn't. Well, what happens? The market reverses back again, closes back above a doji high, and see what we see happening? The market continues higher. We see at any one point in time, the market never takes out the low of these dojis. Never takes the low of that doji out, never takes the low of that doji out on a closing basis. And every time we see the market close above a doji high, look what happens. We see perfect analysis. Immediate results follow. And that's what you want to see. If you see a pattern and you say to yourself, boy, I've seen that pattern before, and this is the outcome. Generally within one or two candles later, we see immediate results. And if that's the case, then go with that trade. So how do you trade it though? Well, how do you trade it means, when do you get in? Where's your risk? How long do you stay in the trade for? On a high failed doji top, you're looking for the market to close above the doji. You're looking to get in on the close or the open in the next session, and you have to risk a stop close only below the doji low. Because you don't want to be a hammer formation, which this is right here, get stopped out of the game, and then watch the market take off without you. That's why it's imperative to use stop close onlys. Now, let's define a stop close only right now before we go any further. Most intraday trading platforms do not accept a stop close only. That means on a 5-minute, a 15, a 60-minute, they don't take stop close onlys. So as a day trader, it's up to you to watch and follow the market at the end of whatever time period you're trading in is. For example, if you're trading in a 5-minute, and every 5 minutes, such as if you get a signal at 11 o'clock and at 11:03 you think you're in trouble, you have to wait until 11:05. That's the end of that 5-minute time period. And 11:15. So if your time frame of 5-minute begins on the hour, every 5 minutes after that, that's when you have to wait for to trigger a signal. Every form of market analysis, every single form of market analysis works the same way. You will not get a stochastic signal until the end of the 5-minute period locks in and the signal closes. So it needs to wait for the market signals, because after all, think about this. In a 5-minute time frame, this doji right here probably had a red candle because it established a low, but then boop, came right back and closed on the open. So you have to wait for the close. And so that means if you're in a 5 minute, you have to wait for a 5 minute. You're in a 15, wait for a 15. 60, wait